This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
You walk into this room at your own risk, because it leads to the future. Not a future that will be, but one that might be. This is not a new world. It is simply an extension of what began in the old one. It has patterned itself after every dictator who has ever planted the ripping imprint of a boot on the pages of history since the beginning of time. It has refinements, technological advances, and a more sophisticated approach to the destruction of human freedom. But like every one of the superstates that preceded it, it has one iron rule. Logic is an enemy and truth is a menace.
Logic is an enemy and truth is a menace. Please, can that go on my tombstone? My rest in peace. Logic is an enemy and truth is a menace. Not hard to figure out where I want to go today. A little backstory. In the early 2000s, I decided to write a book. One of the reasons was because of criticism. I had some critics of my blog, my trend following blog. They were critical of the content. And I thought, well, hell, I'll write a book. I've got enough stuff, I'll write a book. The serendipity of life, the fortuitous chance events. Boom, for me. I got an email from Professor Larry Harris of the University of Southern California, the chair in finance. He said to me, I don't know who you are, but more people download my zero-sum white paper from your world, your websites, than anywhere else. And he said to me, I have a new book coming out. It's a great book, by the way. You can go find it, Larry Harris. I think it's called Trading and Exchanges. So once he started talking about his new book, I thought, this is my opening. I did not know anybody in the publishing industry, not a soul. Absolutely no one. I had a rough idea of where I wanted to go in my first book, Trend Following. I had a rough table of contents. But at that moment in time, I told Larry Harris, I'm writing a book. Introduce me to your publisher. That was an easy exchange, right? He wants me to write a review of his new book. He knows I have an audience. I said, hey, introduce me to your publisher. He did. I believe the guy's name was, I'm not going to out him now. That's not fair. He introduced me to Oxford University Press. We got to the point where it was deal time, signature time. They were going to sign me for my first book. At the last second, they backed out. It was so last second, I got pissed off on the phone at the guy. I was like, dude, this is not appropriate. We've got like deals in front of us ready to sign. This is really bad. He must have felt bad because I asked him, I said, introduce me to somebody else. Introduce me to another publisher. He introduced me to Jim Boyd at Financial Times, Prentice Hall, Pearson, all these different names. But it was the FT imprint. Jim Boyd was great. He didn't pay me that much money. I think $15,000 for the Trend Following book. Now it's sold over 100,000 copies, so it's made a few bucks. Thank you. Yes. But Jim had no idea what to expect. He took a flyer on me. But the setup there for where I'm going in this podcast is quite simple. Financial Times, FT, that's my publisher. That's been my publisher for 3 books. Now, I will give FT credit, even though they've been the publisher of my 3 books on trend following, their publishing world and their media world are not connected. Anyone that reads the Financial Times knows they don't believe in trend following. For the last 15 years, you can go find articles left and right. They ripped my book, Trend Following. They rip the strategy every chance they can. They literally don't understand it. They are a big media conglomerate that's into fundamental analysis. That's what they push. Any angle they get a chance to rip Trend Following, they will. And it's always this kind of rip of like, well, we really don't know what it is, so we're going to give some smarmy one-liners and da-da-da-da-da, and hey, investors get ripped off and all this other stuff. Another one of those articles, September 2015, is out in the FT. Stephen Foley, author. Now, before I dig into the Stephen Foley article, I want to connect this to something else to get even a larger picture of where media goes in their contradiction, hypocritical foundations. At the exact same time, there's another article, Fears Grow Over U.S. Stock Market Bubble. Robert Shiller, professor who won the Nobel Prize in 2013, making the case for a stock market bubble. Let me dig in a little deeper here so you know where I'm going. First, the trend following article by Stephen Foley. Let me read a few excerpts. These trend following funds, also called commodity trading advisors or systematic macro funds, trade on the theory that assets that are going up are more likely than not to continue going up, and that assets that are going down are more likely to continue going down. There is strong academic evidence supporting the idea that momentum is an enduring feature of financial markets, and it makes intuitive sense, too, given herd behavior among investors. Yet in recent years, trend-following funds have provided almost relentless heartbreak for those who buy them. Too little divergence between asset classes because of quantitative easing, too many sudden reversals of trends, financial conditions never seem to be quite right. One is reminded of Sybil Falty's mother with her morbid fears, quote, open spaces, confined spaces, it's very difficult getting the space right for her, really, end quote. The promise of managed futures is of returns uncorrelated to the rest of the financial markets and a hedge against a long slide in equities. But investors are left asking if they have again been suckered into a strategy that has lost its ability to perform. He continues, performance-chasing retail investors have also been burnt. For nearly 20 years, I have seen that exact same article penned. Change the dates, change the headline, change the author name. It's the trend following is dead article. At the exact same time, the strategy that is predicated on following trends, not predicting where markets will go next, at the exact same time, FT is interviewing Robert Shiller, who's saying there's a market bubble. Does anybody see the contradiction? Does anybody see the hypocrisy? I guess there's so much news out there. There's so much information. What always fascinates me is to see these two articles essentially competing against each other, both written in the same newspaper. One is so we hate trend following, and then the other one comes out and says, but we're in the middle of a bubble. Guess what? If we're in the middle of a bubble, there is no greater strategy than trend following. Nothing. Zero. Nothing. It's the best one there is. Now, of course, the two articles in FT, the two different authors, don't bother to compare notes. They just say what they want to say. And I guess they expect nobody will see these contradictions. Now, the FT piece with Shiller also included a video. Let me play that audio excerpt.
Hello and welcome back to The Note, coming to you today from the beautiful Connecticut campus of Yale University, where I'm going to be talking to the Nobel laureate economist Robert Shiller. Now, Bob Shiller is famous for many things, but perhaps above all for the so-called Shiller PE multiple, which he has used to put valuations on the US stock market and showed that it was wildly overvalued ahead of the crashes of 2000 and 2007. More recently, it's become much more controversial because it's been saying incorrectly that you should be getting out of the US stock market for several years now. I started by asking him what are the limits of his PE multiple.
The reason CAPE ought to work to predict the market is that earnings have always been constructed by accountants as some measure to indicate fundamental value of a company, and so price is high relative to earnings. That's a bad sign.
Let me interject at this moment in time, as I'm about to criticize a winner of a Nobel Prize. He said ought to work. ought to be able to predict. Now, he's not a man of prediction, as far as I can tell. He's not a guy that says he knows market timing. And in full disclosure, I have asked Professor Robert Shiller to appear on this show a few times, and so far have been unsuccessful. So I don't want somebody to come back to me and say, hey, Mike, you're offering a criticism here, but you're just doing that because you couldn't get the famed professor on your show. Well, I would ask him some of these questions if I got him on my show. Let me continue, but keep in mind that initial thought that he's saying ought to work, ought to be able to predict. Continuing.
But we're clearing out the significant problem of earnings is that they're volatile from year to year. So let's average them over some years. That gives a better indicator of fundamental value. And when John Campbell and I studied it, we found that it substantially predicts returns over the next decade, if not tomorrow, but at least over the longer term.
Now, one of the criticisms that has been made is that accounting conventions have changed over time, which means that it's not directly comparable, that it may not be as expensive relative to history as it looks. Do you think that's a fair criticism?
It's a problem. I don't know that it's a serious problem, partly because accounting standards have changed in response to developments. I think we're better off with the changed accounting standards than if we ignored all the things that have changed since 1871. I have had trouble finding experts on the history of accounting.
Okay, let me pause for a second. Does anybody out there care about the accounting? Do you really think you are going to be able to wrap your arms around accounting standards and then make a buy and sell decision based on accounting standards? Now, if I go back to the first article from FT, the one that rips trend following, he says, quote, these trend following funds, also called commodity trading advisors or systematic macro funds, trade on the theory that assets that are going up are more likely than not to continue going up, and that assets that are going down are more likely to continue going down. Now, that's not a theory. There is massive evidence about the efficacy of trend following, massive performance evidence. It's not an academic theory. So if you're sitting there and you're saying to yourself, okay, I've got one FT article that's ripping trend following. I have another FT article, piece, video with the famed Professor Robert Shiller, who obviously has some great insights about crowd behavior. We're both in alignment about the nature of bubbles. But look at the difference behind how Shiller might go about examining a bubble and what to do, and the trend following what to do. They're so polar opposite. In the first few minutes of listening to Shiller talk, do you really think you can apply any of that to make money? Continuing.
There must be some somewhere. I haven't found them.
Right.
People are not interested. It's just like they used to throw away data on trades. We didn't have a computer tape of stock prices until the 1960s. So I can't be sure that the changes in accounting definitions are for the good as I imagine they are. So yes, there's some guesswork. By the way, some people who have the philosophy that I will only use data that I can really verify are limiting their scope of history. And right. History is the main teacher of lessons about financial booms and busts.
I suppose one other criticism that people who are trying to explain away the high level of CAPE at the moment make is that there was this extreme fall in earnings, very dramatic, during the financial crisis. Is that a reasonable concern that stays in the multiple?
Well, I don't see any reason to exclude it because it was in response to a serious recession. The response tended to happen suddenly, partly because companies like to take write-offs right away during the recession and blame it on the recession, and then the earnings can recover from there. It's some little bit of manipulation in there. But if I average over 10 years, I don't see that that's the problem. And I think that we want to reflect the actual losses that companies made.
Okay, now let's get to the present. We've just had what, at the very least, is a correction in stock markets. Certainly the Cape measure implies that we need rather more than the correction we've had so far. How can we work out whether we have much further to fall? How much further to fall could we have?
Well, that's a difficult question.
It's an impossible one.
You expect me to answer it?
This is why I like Robert Shiller. I disagree with his idea of the best way to perhaps trade the markets. I disagree with the idea that the indicators that he's developed are frankly really useful. They're interesting. They give some insight on crowd and herd behavior. But here you have both of them knowing that you can't make the prediction. But even though they both know you can't make the prediction, they're still going to talk about it. It's the definition of insanity. Not the definition that this FT reporter is insane, not the definition that Robert Shiller is insane, but the notion that two bright people are going to talk about prediction when everybody knows it doesn't work is crazy. Excuse me for getting a little passionate, but it's just borderline insane. Continuing.
I tell you, though, that I'm better known for Cape.
Yes.
But I have also, for years, been constructing my own confidence indexes. And I've been studying both stock market and real estate in the United States, a loss of confidence in valuation of the market, both for individual and institutional investors. The question I ask is, do you think the stock market is overvalued, undervalued, or about right? And I can construct a confidence index from that. And that index is at lower levels than it has been since the peak of the market in 2000. It was very low. This is why I think of I call it the millennium boom, was a bubble.
Right.
Because people increasingly, as the 1990s went on, had lower and lower confidence in the valuation of the market. But they were still buying and bidding up prices. That's the sign of a bubble. So it looks to me a bit like a bubble again, with essentially a tripling of stock prices since 2009 in just 6 years.
Again, for that bit of insight alone, for him to at least just say a tripling of stock prices in 6 years. I mean, Bob Shiller is saying, let me pause for a second and take that in, and to think about the consequences, the repercussions that could unfold from that. And then think back to the FT article that I read at the beginning of this podcast that was making fun of trend following. Trend following's dead. Trend following doesn't work. And what's even more interesting in that article is that last line that I read in the trend following article: performance chasing retail investors have also been burnt. Performance chasing retail investors. Am I supposed to respect these performance chasing retail investors, whatever the hell that means? Basically, it means people buying a fund, whatever that fund might be exactly. I don't keep track of the trend following funds. I look at a few key barometers in my mind, in my world, but I don't keep track of funds. I don't keep track of fees. I could care less. It's about the strategy. I'm sure there are some unscrupulous trend following traders out there that charge too much fees and don't deliver great performance. I'm sure as shit they're out there. But don't pretend that they're only in the trend following world. That's silly. And again, performance chasing retail investors, this is like saying, hey, pet the stupid dog over there. Just pet the stupid dog on the head. It's a stupid dog. We all know it's a stupid dog, but respect the stupid dog. Again, the way people frame, the way these media personalities frame the discussion and frame the argument, and I beat this drum on my podcast, they have an agenda. They are either selling advertising or selling fundamental strategy. They have an agenda, and their agenda is to promote buy and hold strategies, which is always so interesting to me that when you bring on a Bob Shiller who openly says, we're in a bubble, And then the other articles are saying, but don't look at the strategies that deal best with a bubble. Continuing.
And at the same time, people losing confidence in the valuation of the market.
So ultimately, that implies this is not over just yet.
The problem is the short run thing of saying, when will it turn? And I don't have, does anyone have a good way of saying that? Now, the thing is, when we see a correction, and also an increase in volatility and an increase in the VIX volatility index, that shows that people are thinking something, worried thoughts.
I'm on the same page with Bob Shiller there. When that volatility starts and that VIX starts to get a little excited, you know something's up. Nobody can predict the timing, including trend following traders. No one can predict the timing. That becomes the asinine aspect of the FT trend following article that I read in the beginning. Even though he seems to understand what trend following is, he's upset because the dumb investors did not get performance. I've not yet seen the trend following traders out there that promise performance. At the end of the day, if you want to be an investor in a trend following fund, do your homework about the strategy. If you just trust and you buy at the high and you get burned and you pay the wrong fees, that's your fault. Continuing.
And it suggests to me that many people are reevaluating their exposure to the stock market, and we could see aftershocks of the correction. But not maybe right away, maybe in 6 months or a year.
We could see maybe aftershocks. Sure, who's to disagree? That's just his opinion. But what good is the opinion? What good is that kind of opinion? That's the whole point here. My opinion is worthless as well. My opinion is only useful if it's attached to a particular strategy that makes sense for dealing with uncertainty, that makes sense because I'm willing to give up control because I don't know what's going to happen tomorrow. That's the difference. Continuing.
So I'm not being very helpful about market timing, but I could easily see aftershocks coming. I think the investor's demand is a little bit insecure. I wish I knew better how to time from that, but I think that there is a concern about a major bull market developing.
Okay.
A concern, but not a clear forecast. I'm sorry, I don't know.
Thank you very much indeed.
My pleasure.
I think at the end there, he meant a major bear market developing. I don't think he meant bull. And if I go back and look at some of his other articles that have come out in 2015, he's gone on record as saying, unlike 1929, everything, stocks, bonds, and housing, is overvalued. So while I might have a disagreement with the good professor about technique and the best way to trade any of these markets, and I'm sorry, I think the evidence is on my side, find me the evidence that beats the trend following evidence. Where is it? But the professor's desire to bring up the notion of bubbles, to talk about mood, to talk about extremes, well, you got to give him credit for that. In fact, I want to read one last excerpt from Robert Shiller. This is a question from Goldman Sachs to him in 2015. Is the equity market a bubble today? Shiller responds, I define a bubble as a social epidemic that involves extravagant expectations for the future. Today, there is certainly a social and psychological phenomenon of people observing past price increases and thinking that they might keep going. So there is a bubble element to what we see. But I'm not sure the current situation is a classic bubble because I'm not certain that most people have extravagant expectations. In fact, the current environment may be driven more by fear than by a sense of a new era. I detect a tinge of anxiety and insecurity now that is a factor in markets, which is quite different from other booms historically. If I had to oversimplify with just one idea, it would be what I just alluded to a moment ago, that people are not confident in their future. They remember the financial crisis and they worry. They hear about inequality through the Occupy Wall Street movement and many other places, and they worry they will fall on the inequality spectrum in a decade or so. They observe the amazing but perhaps unsettling rise of information technology and they worry. As a result of all of this anxiety, they want to save more. But given the lack of options to invest in a high return, they end up just bidding up prices of existing assets. That in turn creates disappointment, more concern, and perhaps the feeling that they might be too late because of how much the market has already risen. But they still invest in it because of their anxieties. End quote. That is just classic, brilliant analysis from Robert Shiller. Spot on target. Describing the phenomena of a bubble. What is going on inside? How does it move? Why does it move? Now here's the trick. You can't trade off any of that. None of that is useful for trading. It's damn useful to understand the landscape, the playing field. It's not useful to make a decision because it's all conjecture. It's all guessing. The most important thing he has said today, tripling of stock prices in 6 years. That is cause for pause. I want to take the two different thoughts today. The FT piece that rips trend following, the FT piece that says we're in a bubble. And I want you to think about the purpose. I want you to think about the ideas behind what they're doing. These people can't give up control. They must have control. Even though they can't have it, they must have it. They must talk about it. They must try to find control. The FT piece about trend following, that author wants control. He wants predictable performance. So do the so-called retail investors chasing that performance. They want prediction. They know it's impossible, but in the very next breath, they demand it. It's psychotic. It's like straitjacket time. I bumped into someone the other day. Their expertise was feng shui and metaphysics. And he looked at me quite confidently and he said, "Michael, I know nothing about investing." And I said, "En contraire, you know quite a lot. The moment of right now is all we have. We don't have the past and we don't have the future. I don't know anything about your world, but I know you understand the moment of now. And if you understand the moment of now, you are 1,000 light years ahead of everyone else." And building on the moment of now, giving up control. Knowing that you can't control what the markets will do next. There is absolutely no way anyone can. I'm sure I sound like a broken record. I try to make this entertaining. I try to bring it from different vantages, different angles, different perspectives to bring up discussion to get people to think. But that giving up control is terribly important. Now, I'm sure some of you are sitting out there and saying to yourself, "Michael, you've played quite a few Alan Watts clips. Are you some kind of a hippie sitting out somewhere on some high plane taking bong hits all day long? And have you lost your mind? And it's one big LSD trip?" Not exactly. Not my cup of tea. But every time I hear Alan Watts talk, it sounds like a trend-following trader. Think about some of the things that he just said. When merits are accomplished, it lays no claim to them. If a big trend comes along and you capture the majority of it, you can't lay any claim to that trend. It happened. All you did was follow your rules. You went along, but you can't lay claim to the trend. You didn't do anything. You didn't make that trend happen. You went along for the ride. Crowd Psychology 101. All of the behavioral Nobel Prize winners should exist in the possession of the trend following legends. There's no doubt about that. I'm not saying the guys that have won them should not have, but the trend following traders for their work, the ones going back with 3 and 4 decades of experience and success, they deserve it as much or more. Watts also says in that piece, trust everyone else. Think of everyone else as the markets. The markets are everyone else, and the markets are defined by the price each day. You can reduce it all to that. Everyone else is defined and reduced to the price action, and you can make your decisions off that. Think of the possibilities when you reduce decision-making to one variable. I've played on this podcast the interview with Schiller, the details that he's talking about, accounting standards, his CAPE ratio, some other fundamental piece of information. The fundamental data never ends. It doesn't stop. It's a wave and a wave and a wave, and there can never be enough fundamental information. But if you go all Alan Watts on the markets, you're only left with one strategy. There is no other trading strategy where Alan Watts could dovetail with, where Alan Watts could fit with. And one last point that he made there that I immediately think of when it comes to the markets. No power over others, no power over the markets. What happens if you relinquish the power? Think about your mind for the rest of your life. Hey, guess what? I know we all like to pretend we live forever, but we don't. So what choices are you going to make life smoother? Are you going to have the anxiety for the rest of your life? Or can you take a step back and see a different way to look at things? No power over others and the markets is an exceptionally brilliant way to look at the world, life, and yourself. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.